Today on Investing 101, Jeff Holt is joining us, and Jeff is an associate director at Morningstar. We're here to talk about target date funds. So why don't you define them for us, first of all?
Well, target date funds are a diversified portfolio that holds both stocks and bonds, and also holds U.S. stocks and international stocks. And what the distinguishing feature of target date funds is that they have a date in the name of the fund, and that corresponds with the target retirement date for an investor. So they're intended for a retiree to put all their assets into that fund and to invest in it for multiple decades and to accumulate assets for retirement.
So not cycling in and out with the market. This is a long-term, long-tail investment.
It's definitely a long-term investment intended to be a multi-decade investment.
And the actual fund itself is made up of multiple asset classes, I understand.
Yes, that's a very important aspect of them. They're diversified portfolios that have, like I mentioned, they have stocks and bonds. But it is notable that there are different target date managers that provide different funds, and there are differences in how those asset managers come to the mix of stocks and bonds and international and U.S. stocks and high yield bonds versus core bonds.
Now these funds you mentioned to me are growing in popularity because of?
Well, they're growing a lot in popularity because they're a default investment in many 401k plans. So for investors that are in a 401k plan and don't want to make a decision on how to pick from underlying options in that plan, your employer will default you into most likely a target date fund. And so that's why they've really risen in popularity. Over the last 10 years, they've grown from roughly under $200 billion to now they're approaching $1 trillion in target date mutual fund assets.
That's significant, $1 trillion. Wow. So now there's some specific do's and don'ts as far as investors are concerned for using these as part of their portfolio. So first of all, the do's. The do's is
to stay the course. These aren't meant to be short-term investments, so invest for the long term. And it's important, the target date funds aren't guaranteed that you'll have enough for retirement, so the do from the investor standpoint is to make sure that you're saving enough for retirement as well.
So this could be kind of like a backbone, but other classes that an investor might want to look at for their retirement, including the target date funds.
The target date funds can be the sole investment. That you can put 100% of your assets in the fund because it is a diversified portfolio. But investors do have the option, if they want to mix it in with some other asset classes on their own, they could decide to do that as well.
So it kind of sounds like the don't is maybe the typical thing, like, just don't go in and out of these. So give me a don't.
A don't would be not to trade in and out of them, and not, and one broad trend they're designed to be one fund for the target date, so that you don't need to hold multiple target date funds. You can just hold one that corresponds to when you plan on retiring.
And since these have these multiple classes, they're relatively insensitive to the market ups and downs over many months or even years.
Yeah, so they're diversified portfolios, so they should never be your top performing fund, but it should never be your worst performing. The intention with the diversification is to provide a smoother ride over the long term, and the target date funds do become more conservative over time as an investor gets closer to retirement. So that's an important aspect of them as well.
Great. Jeff, thanks for joining us today.
Thanks.